Hi, everyone. I'm Rick Bensignor, president of In the Know Trader, and welcome to this week's show. This week, I want to show you some key S&P 500 levels that need to trade in order to get institutions to act on the movement, and then, of course, where the subsequent signals would take you to. We'll also take a deep dive into the energy sector and see how things look year to date. The sector is up less than half of what the S&P is and is the third worst performing group in 2019 of the 11 macro sectors. I'll also show you individual charts and analysis on, probably about 8 names or so. These would be the largest cap names across the energy subsectors. You can see them on screen here now as the ones that we'll be taking a look at. But before we get into those topics, let me tell you of 2 upcoming media events I'll be interviewed on in the next week or so. First is this Thursday, May 30th. I'll be with Maria Bartiromo on her show on Fox Business TV sometime between 8 and 9 in the morning Eastern time. I don't have a definitive hit time yet, but I know it is between 8 and 9. So that's this Thursday. And then secondly, next Tuesday, I'll be the guest on StockCharts TV's Market Watch's live show. And I believe that's probably about 12:20 or so Eastern time to about 12:50 or so. For those of you who are regular listeners, you'll know that most weeks they bring in a special guest to discuss things for about a half hour or so. And we'll again introduce some of the models we use and the approach we take. So always have a good time on that. I hope you can tune in to both of those in the next week. So let's get into the meat of today's show. And so let's flip to our chart. Okay, so let's start off by looking at the S&P for some of these key levels that we think institutions are likely going to react off of and play from in order to get some piece of a next move. It doesn't have to be a monster size move, but clearly for the last couple of weeks, we've been stuck between pretty much 2,800 and 2,890 or so. And what at least the DeMark models would indicate, let's start here with this one that's kind of in the teal colored oval. This horizontal line here has a value of 2859.4. We need to pass through it with a qualified and confirmed close above that. In the No Trader clients understand what that is in the sense of what the rules are in order to properly break above this level. If the S&P can do that, then it would next target 2917 as far as the first move off of this potential upside breakout. On the downside, I've got this kind of purple colored ellipse, and you'll see here, maybe I can even blow it up, make it a little bigger. So this level is basically 2837. And in order to kick that in as far as a bearish propulsion level, with last Friday being an up close, today, if we close down on the day, and beneath this obvious 2837 level, then an open lower tomorrow and trade down from that open, then it would say that 2720 down here would be the next target area. And that just by chance happens to coincide with the same low that we saw in March. So that would be the next target level. It also happens to be a 38% retracement from the Christmas low. So if we kind of show you all the price action since the Christmas bottom up to now, what's the all-time high, a 38% move down there happens to coincide with where the propulsion exhaustion level is. So that would be the logical downside target, essentially a test of the March low. There is also this very important level, this dotted line that's within the yellow highlighted space at 2799. That is called the TDST level. That is the lowest low in a setup 9 count up, which we saw. So this essentially says that there's support here. Notice we've twice bounced off that level since we peaked. So this we've got a zone between roughly 2,800 and 2,837 that's been the important support. And so far, the market hasn't been able to break down from it, which is good, but it has also failed a few times up against this propulsion level. And even though back in here on May 16th, we closed above it again, the rules weren't met for it to be a proper breakout, so it is still an active line that says we need to break through that. So that's a look at the S&P. Properly break through 2859, we should get to 2917, properly break beneath 2837, and we could fall as much as 2719. That's the way we see things, and what we think likely institutions are looking at also. Let's now move to kind of this energy space, which is the focus of today. And again, I started out today's show by saying that the S&P Energy Index, it was up, I believe, as of last Friday's close, 6.6% year to date, which is less than half of the 13.7% that the S&P itself is up this year. So it's a bad underperformer for the year. But more important than that is taking a look at the big picture of XLE against the S&P. So this is the total trading history on a monthly chart of XLE divided by SPY. When the chart is moving higher, that means energy is outperforming the S&P. When the chart is moving lower, it means energy is underperforming the S&P. So we can see back here in 2008, and I'll just kind of mark it here so you can see the ellipse. You know, that's the all-time high in energy outperforming the S&P. It has been a very poor 11 years since, bringing us down to the current level we're at here. I drew a horizontal line across, so you can see that in relative terms, the S&P has not been, I'm sorry, the energy sector has not been this bad against the S&P since 2000. So we are essentially on 19-year lows in relative performance terms, having peaked in 2008. So I counted, and there's only 2 out of the last 10 years that energy has outperformed the S&P. And that was here in 2010 was one of the years, and I think it was 2014. Actually, no, it wasn't 14. Well, I know it was 2. Oh, here it was. It's probably here in 16. Started on the lows of the year, closed near the highs. That's probably the year. So energy in and of itself has been a terrible sector to invest in over time. Now, that doesn't mean you didn't make money being long some stocks in that sector, but it means you would have done much better if you were just in the S&P itself or other sectors that have outperformed. This is kind of a disaster sector because you're on 19-year lows. So there isn't anybody in the last 19 years who's bought this group who's still holding it that's outperformed. So basically, the entire marketplace is in a bad situation holding onto energy names. Now, I have noticed that back in 2017, you got the first ever, here I'll highlight it, first monthly 13 signal into Mark's work suggesting potential downside exhaustion. We did get a rally into 2018, and energy was one of the best performing sectors for the first half of last year before it fell apart. Now we have a setup 9 count. Still too early to come in and change what has been an underperformer to anything but that, but I'm certainly will be eyeing it over coming months to see if we can get at least minimally a price flip up, meaning a month-ending close that's above the close from 4 months prior, to at least give some sense that possibly this long bout of underperformance is closer to an end. So you have to ask yourself, if you're investing in names in the energy space, why you're doing so. What's the commitment on your point? What's the reason that you would be putting any significant dollars into a group that's underperforming and has continuously underperformed for so many years? So that doesn't mean, again, that you can't trade in and out, potentially make some money, but as investments, these names just have been really bad. And so I caution you about, trying to put too much money in until at least we get some sign that this has stopped underperforming on a longer term basis. So look, we're not far from all-time lows when the XLE started trading in 1999. It's very possible. I don't have the cash S&P Energy Index. It might have been lower, but at least since the ETF is traded, we're talking almost on 20-year lows. So just not a great place to have been invested. So let's take a look at some of the largest cap names. All the charts we're going to look at are weekly charts. So at least we keep in the same time perspective. And the first one we'll look at is in the drilling space. This is ticker symbol HP, Helmerich and Payne. You can see the DeMark upside exhaustion signals perfectly here back in the spring of 2018. Decent decline followed up by a 9 count here, the setup 9. And we still have not gotten on the downside to I've set this here, the kind of maroon colored counts are the aggressive sequential. They'll come in faster than even the red colored counts. They'll get to 13 typically first. So we're still a few weeks away at minimum to potentially have the offsetting 13 signal from these upside exhaustion signals when the stock was in the low 70s. Heck of a good place to identify exhaustion of trend, especially seeing that the stock in round numbers is at $50 and still suggesting that it can potentially go lower. So a name I may become interested in a few weeks, not there yet. Next, let's go and take a look at the biggest name in the equipment and services space. That would be ticker symbol SLB, Schlumberger. Also, kind of a painful chart to look at for long-term investors. The cloud has caught several of the highs. The stock looks like we're darn close to last year's lows. There was a 13 signal in here for downside exhaustion. The risk level on that 13 is right down here at 32.82. So given now that we've got another 13 signal showing up and the stock's trading at 36.5, if we get down to 32.82 in another week or two from now, that may be a place that I decide to, do some buying in, with the understanding that we could still see a move all the way down to 26, which would be the next propulsion target down. So clearly you're fighting trend here by trying to pick a bottom in Schlumberger. It hasn't worked. If I bring in more data, you see that this thing topped out in 2014. Notice here near the high, 13 sell. Notice here at the bottom, 13 buy. Upside exhaustion, 13 sell. Downside exhaustion, 13 buy. These were all good signals. And now we're starting to get some 13s again. So same thing, not quite ready to buy. Figure it probably has another $4 or so to go on the downside. It may have to take out those lows from December in order to shake people out, but it still doesn't mean necessarily it's a buy, but that's where maybe on a longer term basis, I might start to nibble on a name like this. Let's go to the integrated names, because these are the ones that people often think of first when you think about the energy space, and this is kind of the granddaddy of them all, which is Exxon. I can tell you personally, I had held Exxon. I got out months ago at 76. Missed some of the up move that got all the way towards 81, but it's trading 73.60 right now. Oil obviously came off from at $66.50 a barrel. Right now it's trading just under 59. So that's put some additional pressure too. But, in simple terms, put a trend from, let's just kind of put it, market here from all-time highs. So it looks like we took that out all right, so this line got broken by a bit over here. So if we raise it, this line got broken quite a bit. The fullest, most conservative downtrend line from all-time highs is the one I've just drawn. but you can see the clear downside channel that this is traded in. Right here, you're kind of in the middle of things. If there's no one perfect, I'm trying to see here, we're at even, I don't know, something. It's not by any means parallel, and it doesn't capture the lows back in 2015, but you look at this, you get the sense too here. It's very choppy. There are opportunistic buying times where you can take out some money on the upside, but this is just, you know, a heavy chart. And again, just based upon the fact that we're on a 6 count down now towards at least a 9, same type thing, I'd probably be holding off a few weeks before even looking at coming back into Exxon again. What else? I'll take the number 2 name in this space also, which is Chevron, just because, again, it is such a widely held large cap name. And you can see how much better a chart this is than Exxon is, right? Exxon we saw was a kind of channel down, a bearish market over quite some time. Chevron bottomed here in 2015. We actually, you know, there is a valid uptrend line you can draw into the fourth quarter low of 2018. It did stop on the way up on a setup 9, the same way it did it here. What are the setups? 9 consecutive Fridays that the close is above the close from 4 Fridays back. Notice in here, a bottom on a 13. So bottom here, just after the lows. So early part of 16, 13 buy signal. So the DeMark models have been good here too. Here's a 9 bottom for a trading bounce, and so on. So this is much better name. If you want to be into one of the large integrated names, I'd much prefer see you into a Chevron than I would into an Exxon. Just a healthier chart overall. And if I bring in more data here, all right, so back in 2014, this made all-time highs at about 135. Let's just throw a line across. So in 2018 on the highs, kind of tested in there, didn't quite get there. This year's highs are even lower, but you do have an ascending triangle. And obviously, if this could ever break out above 135, it would have significant room to go. But in general, again, this is the better name between the 2 big integrated oil names. So to me, I stick with Chevron over Exxon. In the exploration and production space, we have ConocoPhillips. This is even a better chart. And these lines are just being transposed from the prior charts. So let me get rid of some of these lines and ellipses and just show you that basically we're darn close to all-time highs. So this so far, by far, is the best chart we've seen in the entire sector. We go back to highs from 2014. We tested them in the summer of 2018. We've pushed through. The only thing I'd be concerned about as far as just simply buying it right now as compared to a pullback is we do have this 9 count in here. The propulsion target at 231 was all but met. I'd rather be a buyer on a pullback. If you ever got the chance, I know it's large in percentage terms, but it wasn't long ago that the stock was trading closer to 200. Much rather be kind of a buyer down in here on a pullback, even though it means that you're buying that this would have pulled back underneath that double top, which a lot of technicians would tell you is a warning sign. I tell you that near 200 is the place that I'd be very happy to be a buyer. The other big name in the space is EOG. This made new highs and then certainly fell strongly. So you go back to the 2014 highs. We draw a trend line across. Notice the 13 here, by the way, too, very nicely calling the peak. 13 and 9s in here, a little early, but not by much. And then kind of a bigger space. In fact, now there's even support down into this low 80s level. This bottom here in the low 80s back in 2017 was with a 13, and again tucked in here I can see some 13s suggesting upside exhaustion. We're on a week 5 now towards a setup. This may tuck underneath the lows. I'd say downside targets here anywhere from 82 to potentially 77.5. before, again, I'd kind of be more interested in coming back into the name. Let's move to refining and marketing. We have a few names left before we wrap up the show this week. PSX, which is Phillips. So again, let me take away lines and ellipses from the prior chart and note a few things here. All-time high, exhaustion of uptrend. Just before that, exhaustion of uptrend, and you had a big decline. So whereas a typical standard technician would say, you know, you're moving higher here, no reason to think that this move would be the peak. This is why institutions use DeMark models. This is why I use them as part of how we look at the markets. Significant decline off of all-time highs near in the 120s. Took well longer than 9 weeks, but the pattern in here didn't present anything. But at one point, we finally did 9 consecutive Fridays, close less than close from 4 Fridays prior. It was about a week or two early, and then it did the exact same move on the upside. And now we're on week 8, so we're getting closer to a potential trading bottom again. I would say anything in the upper 70s, especially in the next couple of weeks, would be a place that I would potentially think of coming back into the name for a trade. And if the energy space, you know, recovers at all, we could at least target something like the 100 level, which would be the top of the cloud for months to come. Let's look at Valero, another name in the same refining and marketing space. Problematic chart in many ways, broken underneath the cloud. The cloud is now above us. We are in a week 12 on an aggressive sequential. Next week could be a 13, anywhere from, unfortunately, this is a large percentage, anywhere from 70, well, let's see, we're at 76. This one, I'm not even sure how soon I'd come into. If we got down here near 63.5, that I could tell you I'd likely be a buyer. Before that, I'm not sure, but this is going to have overhead resistance. Look at the significant amount of resistance that was in this level before it finally broke out. It then broke down, came to it, and we fell just beneath it too. So the mid-90s are going to be a hard time. So anywhere from the mid-90s up to 98-ish or so for months to come should be solid resistance. Nonetheless, with the stock trading at 76, that's plenty of room. So this one moves. I don't have a clear sense yet where I'd want to buy it other than down here, but that's still 13 bucks lower than present, which is obviously a very large move. The last one we're going to look at today is storage and transportation area of energy. So we'll go to KMI Kinder Morgan. And what I like about Kinder Morgan is just that you've got a longer term kind of, this went the wrong way, so let's kind of do this again. You've kind of got a longer term double bottom somewhere here between, let's just call it the low teens. You've got several 13 buy signals that represented downside exhaustion in this area here. There's 13.9, 13 here. Now we've stalled on the upside, not only with this 9 count, but with a propulsion target here at 2070. So if we can kind of thrust through this, then you've got targets up here at 20, I don't know, what is that, 26 3/4 or so over time. So this is building a base. Use pullbacks to, I'd say here, 18 and change as a place to do buying. And ultimately over time, I would target this. So this actually has decent upside. So long as the lows that are in place, which to me would appear to be good lows, stay those lows. I think that's it as far as time this week. Again, catch me on Fox Business TV this Thursday morning between 8 and 9 a.m. with Maria Bartiromo, and then next week on Tuesday on StockCharts.com TV, I'll be on Market Watchers Live. Thanks much, folks. Have a good week. I'm Rick Bensignor.
market direction is the single most important thing all investors need to know. Get the advice you need by joining dozens of elite money managers and financial experts, including Steve Forbes, Paul Merriman, Tom McClellan, and Keith Fitzgerald at the Money Show Seattle June 15th and 16th. You'll hear real-time market analysis and learn which stocks, bonds, funds, and commodities you should buy and sell to build a safer, more profitable portfolio. Claim your free pass at seattlemoneyshow.com.
I want to show you a little charting trick that I like to use for the percentage price oscillator, or the PPO. On this SPY chart here, you can see in the indicator windows, I've got two PPOs. The first is the traditional PPO. It's the black line there, and that's the difference between the 12-day EMA and the 26-day EMA. And you can see it's above zero when the 12-day EMA is above the 26-day EMA, and below zero when the 12-day EMA moves below. The red line is the signal line, and it's set at 9. So it's a 9-day EMA of the PPO, and you can identify downturns and upturns in the PPO with that EMA. And the histogram is the difference between the PPO and its 9-day EMA there. You can see when the PPO is below its 9-day EMA, the histogram is negative. And then when the PPO is above its 9-day EMA, the histogram is positive. Now, the little trick I want to show you has to do with the PPO 50, 200, 0. That's the second indicator there. And what I've done is I've eliminated the signal line by putting 0 as that last parameter. So this PPO shows the percentage difference between the 50-day EMA and the 200-day EMA. And you can see that it shows as a histogram when using these parameters, and it has been positive for over 6 months, actually for over a year, actually for over 2 years in this chart. And we can see that it's currently around 3.1% difference. That means the 50-day EMA is 3.1% above the 200-day EMA. And we can confirm that by going to the annotate button there and choosing percentage change. And if you measure the percentage change from that 200-day EMA, the red line, and I go up to the 50-day EMA, there you can see we're about 3.1% difference. And so that's what the PPO is telling you. And so I like to use that longer term PPO to get an idea of the long-term trend.